Imagine a country discovers billions of dollars worth of gold underneath its soil. It mines that gold, exports it, collects taxes, receives royalties, and for several decades, the mining industry generates enormous amounts of money. But then one day, the mine closes, the gold is gone, and the country looks around and asks, what did we actually build with it? The question sits at the center of one of the most important debates in development economics, because minerals are different from agriculture. You can grow another crop next year, but once you remove gold from the ground and sell it, that particular resource is gone forever. This is why Mali's latest infrastructure strategy is so interesting. The government says it could use the revenue generated from its mining sector to support as much as 500 billion CFA francs, approximately 883 million, in financing for energy, water, and transport infrastructure. The mechanism behind this plan has already mobilized approximately 109 billion CFA francs between January 2025 and June 2026. According to the government officials, potential projects include roads, railways, energy infrastructure, water infrastructure, river transport, and projects connected to Mali airlines. But this is not simply a story about Mali spending mining money. The big economic question is, can Mali turn temporary mineral wealth into permanent productive assets? Because if it can, gold mined today can still be helping Mali's economy decades after the mines themselves have closed. To understand why this matters, we first need to understand just how important gold is to Mali. Gold dominates the country's export economy. IMF projections indicate that gold exports could equal more than 20% of Mali's entire GDP in 2026, making the metal by far the country's most important export product. That creates enormous opportunity.
The dynamic has changed with the AISC authorities. Because today, we are committed to defending our sovereignty, to defending the interests of our people. These interests are inevitably now tied to strategic resources, everything related to gold, everything related to electronics, everything related to gas.
But it also creates enormous vulnerability, because when an economy depends heavily on one commodity, the country's fortune becomes linked to factors it cannot completely control. International gold prices, mining production, foreign investment, reserves, discoveries, operating costs, and relations between mining companies and the government. If gold prices rise, government revenues can increase. If mines close or production falls, revenues can deteriorate. This is known as commodity dependence. And one of the great challenges facing resource-rich African economy is how to use commodity well to build an economy that eventually depends less on commodities. That sounds contradictory, but it is actually the entire point. Use natural wealth to finance diversification. Mali changed the rule for its mining industry. In 2023, Mali introduced a new mining code. The reforms increased the government's participation in mining projects and changed the fiscal relationship between the state and mining companies. Under the framework, the Malian state can hold a 10% free stake with the possibility of purchasing an additional stake, while private Malian investors can also participate. Combined Malian public and private interest in qualifying new projects can reach as much as 35% compared with its lower participation under the previous framework. The government has also pursued unpaid taxes and mining revenues, and this has not happened without conflict. The reforms produced serious dispute with mining companies, most notably Barrick. That dispute was eventually resolved, and in February 2026, Mali renewed Barrick's Loulo mining license for another 10 years. This tells us something important. Resource nationalism can increase the government's share of mineral wealth, but governments also need mining companies to continue investing, exploring, and producing, so the economic objective cannot simply be take as much revenue as possible today. The objective should capture a fair share of resources while keeping the sector productive enough to continue generating value tomorrow. That balance is difficult, but it is essential. This is where Mali's strategy becomes particularly interesting. Instead of allowing all additional mining revenue to disappear, it's normal government spending. Mali has established a mechanism connected to financing energy, water, and transport infrastructure. The country's government says more than 109 billion CFA francs had already been mobilized through the mechanism. By the end of June 2026, Finance Minister Alussein Sano has said the fund can generate at least roughly 50 billion CFA francs annually. That recurring revenue could potentially be used to support financing up to approximately 500 billion CFA francs. Now, there is a very important distinction. Mali does not already have 883 million sitting in a bank account waiting to be spent. The idea is that predictable mining revenues could potentially be leveraged to raise much larger financing. This means Mali is effectively trying to transform future mining income into infrastructure today. And economically, that can make sense if, and this is a very big if, the infrastructure being financed generates enough economic value. There is actually a well-known idea, natural resource economics. When a country extracts a non-renewable resource, it is effectively selling part of its natural wealth. If the money is simply consumed, the country's wealth disappears. First, the mineral disappears, then the money disappears. But if the revenue is invested into productive assets, one form of wealth is converted into another. Gold underground becomes electricity. Infrastructure, gold becomes electricity. Infrastructure, gold becomes roads. Gold becomes water systems. systems. Gold becomes railways, gold becomes skills, gold becomes productive capital. This is a much more sustainable development model because eventually the mineral deposit may decline, but the road remains, the electricity network remains, the dam remains, the railway remains. And if those assets increase the productivity of the rest of the economy, they can continue generating economic value long after the original gold has been exported. That is the deeper significance of Mali's strategy. Of all the possible investments, electricity may have one of the largest economic impacts. Latest World Bank data put electricity access in Mali at roughly half of the population in 2024. But access alone does not tell the entire story. Business also needs reliable and affordable electricity. Imagine a Malian entrepreneur trying to establish a factory. He buys machinery, he rents land, he hires workers. Then he discovers he must spend heavily on diesel generators. Yeah, because grid electricity is unreliable. Immediately his cost of production rises. Now compare him with a manufacturer in a country with dependable electricity. The foreign producer may be more competitive before the first product even leaves the country. This is why electricity infrastructure is not simply an energy policy. It is an industrial policy. Better electricity can support food processing, textiles, cold storage, mining, digital business, manufacturing, irrigation, and small enterprise. So if mining revenue finances more reliable energy, Mali could use one sector, mining, to increase productivity across many others. That is exactly what economic diversification requires. Then there is transportation. Mali is landlocked. That means almost every international shipment must travel through neighboring countries before reaching a seaport. This creates what economics call trade costs. If it costs too much to move goods, businesses become less competitive. A farmer may produce excellent mangoes, but if transportation to market is expensive, part of his potential profit disappears. A factory may manufacture competitively, but if moving its products to Dakar, Abidjan, or another regional market costs too much, exports become harder. This is why roads and railways matter. They reduce the economic distance between producers and consumers. And infrastructure does something else that is often overlooked. It can change which businesses are profitable. A village without a good road may not support a large commercial farm. Build the road and suddenly trucks can reach that farm. Warehouses become viable. Processing plants become viable. Retail networks expand. Land values change. Investment follows infrastructure. So when Mali talks about using mining revenue for transport, the economic return should not only be measured through tolls or ticket prices. The real return could appear throughout the economy. The regional dimension is also important. Mali, Burkina Faso, and Niger have been developing deeper cooperation through the alliance of Sahel states. The three economies face similar structural problems. They are landlocked, they need more electricity, they need better transport, they need stronger industrial bases, and they need cheaper ways of trading with each other and reaching international markets. That creates an interesting possibility. Imagine better transport connections between Mali, Burkina Faso, and Niger. Imagine Niger eventually exporting refined petroleum products deeper into the Sahel. Imagine Mali using mining revenue to improve transport and electricity. Imagine Burkina Faso developing greater energy and industrial capacity individually. Each market has limitation. Together, deeper regional integration creates scale, and scale matters. Factories need customers. Transport infrastructure needs trade volumes. Power projects need demand. Regional integration can therefore make projects economically viable. That might be difficult to justify using one domestic market alone. There is, however, an important danger. Mali is talking about leveraging predictable mining revenues to raise much larger sums. That means borrowing and debt is not automatically bad. Borrowing 100 million to finance wasteful spending can make a country poorer. Borrowing 100 million for infrastructure that raises productivity by more than the cost of debt can make a country richer. The question is, what are you borrowing for? If Mali raises hundreds of dollars of billions, project selection becomes critical. Projects should ideally have strong economic returns. They should solve real infrastructure bottlenecks. Procurement should be transparent. Construction costs should be controlled. Maintenance should be funded, and political prestige should not be determined by which projects are selected. Because a beautiful railway and that very few people can use becomes a financial burden. An airport without enough passengers can become a liability. An electricity project that charges unsustainable tariffs can fail. If it can fail, infrastructure is valuable only when the economics